You check your phone, see a notification from your bank, and your stomach drops before you even open it. A declined transaction. Not because you don't have the money, because your credit score decided you don't deserve a lower interest rate on the thing you're trying to buy. Sound familiar? Here's the part that really gets me. Most people think a credit score is just some abstract number that either hurts or helps them a little. What they don't realize is that number is quietly draining tens of thousands of dollars out of their life, and almost nobody shows them the actual math behind it.
Let's start with the myth. Most people think credit score only matters when you're buying a house or a car. Get approved, move on, forget about it. That's what the system quietly relies on, because the truth is a lot more uncomfortable. Your credit score touches almost every major purchase you'll ever make, and the gap between a good score and an average one isn't small, it's massive.
Let's run the actual numbers. Say you're financing a $30,000 car. With a credit score in the high 700s, you might qualify for an interest rate around 5%. With a score in the low 600s, that same loan could carry a rate closer to 14%. Over a 6-year loan, that difference isn't a few $100s, it's over $7,000 in extra interest for the exact same car from the exact same dealership on the exact same day. Same vehicle, same mileage, same color. The only difference is a number sitting quietly in a database somewhere.
Now, stack that on a mortgage, because this is where the math gets almost impossible to ignore. On a $400,000 home loan, the difference between a great credit score and a mediocre one can be over 1.5 percentage points in interest rate. Run that over 30 years, and you're looking at more than $130,000 in extra payments. Not because you bought a bigger house, not because you overspent, just because of a number most people never actively manage. Let that sink in for a second. $130,000 is more than most people's entire retirement savings, and it evaporated silently, one monthly payment at a time, because nobody sat them down and explained how any of this actually worked. Here's where it gets worse. Credit score doesn't just affect loans. It quietly follows you into places you'd never expect. Some insurance companies use a version of your credit history to help set your premiums, meaning two people with identical driving records can pay wildly different amounts for the exact same coverage. Landlords use it to decide whether you even get a callback on an apartment application, sometimes before they've met you or seen your income. Some employers glance at it during hiring for finance-related roles, treating it as a proxy for reliability. That number is working in the background of your life constantly, shaping decisions other people make about you, and most people have no idea how much leverage they're giving away by ignoring it.
So why does this happen? It comes down to one word: risk. Lenders and insurers aren't punishing you personally. They're pricing in the probability that you might not pay them back, based on patterns from millions of other people who behaved the way your credit history suggests you might. A lower score signals more risk, so they charge more to protect themselves. It's not personal, it's math. But here's the good news nobody tells you. Because it's math, it's also completely learnable and completely fixable, usually faster than people expect. Let's break down exactly what's feeding this score, because most people can name maybe one factor and have no idea there are several others quietly doing damage.
The biggest lever, making up roughly a third of your score, is payment history. And this one's brutally simple. One missed payment, even a single one, can undo months of progress and stay on your report for years. Automating your minimum payments removes the human error that costs people the most points. This isn't about being perfect with money. It's about removing the possibility of forgetting.
The second biggest lever is credit utilization.
how much of your available credit you're actually using at any given time. Sitting above 30% utilization can quietly tank your score even if you pay on time every single month. Here's what almost nobody explains. Your utilization is usually measured at the moment your statement closes, not when you pay it off. So you could pay your card in full every month and still get hit with high utilization if you happen to swipe a lot right before the statement date. Drop your utilization under 10%, and for a lot of people, their score climbs within a single billing cycle. No new income required, no side hustle required, just restructuring how and when you use credit you already have. The third factor is length of credit history. This is the one people accidentally sabotage the most. When you close an old credit card because you think you're simplifying your finances, you're often shortening your average account age and quietly lowering your score. That 15-year-old card sitting in your drawer that you never use is doing more for your score open than closed. The fourth factor is credit mix, having a combination of different account types like credit cards, an auto loan, maybe a mortgage. This carries less weight than people assume, but it does mean someone with only one type of credit will likely score lower than someone with a healthy variety, all else being equal.
And the fifth factor, the one most people trip over during major life decisions, is hard inquiries. Every time you apply for new credit, a lender checks your report, and that check itself dings your score slightly. Apply for 5 store credit cards in 1 month chasing discount codes, and you've just handed away points for essentially nothing. This is exactly why applying for multiple loans right before you need a mortgage is one of the most common self-inflicted wounds in personal finance. Now, let's talk about the part nobody wants to admit. A lot of people avoid checking their credit score altogether because they're scared of what they'll find. But avoiding it doesn't freeze the number in place. It just means you lose the ability to manage it. The lenders, landlords, and insurers checking it aren't avoiding it. They're using it every single time you apply for something, whether you've looked at it or not.
Here's the real takeaway. Your credit score isn't some background detail of your financial life. It's a lever that's worth tens of thousands, sometimes hundreds of thousands of dollars over your lifetime. And it's one of the few financial levers that costs you nothing to improve. You don't need more income to fix it. You don't need to cut back on coffee or skip vacations. You just need to understand the math well enough to stop losing money you never even knew you were losing. So here's what I'd actually do if I were starting today. Check where your score currently stands. Most banking apps show this for free now. Look specifically at your utilization and your payment history first, since those two alone make up more than half the equation. Fix the highest impact item first, not the easiest one. And before you sign your next loan, whether it's a car, an apartment, or a mortgage, take 5 minutes to check where your score actually stands before someone else uses that number to make a decision about you. That 5 minutes could be worth more than most raises you'll ever get. By the way, my name is Brett, and this is exactly the kind of thing I spend way too much time digging into. The systems that quietly move money in or out of your life without anyone explaining the rules. If this changed how you think about that number, hit subscribe so you don't miss the next one. See you in the next video.